Hey everyone, me Kevin here. The market basically collapsed today. It was pretty bloody, and I'm not talking about like a Tuesday kind of collapse where we have a Larry Kudlow V-shaped, kind of crash. The market opens up, it crashes, we get to the lowest points we've seen, like Tesla 610, and some of these crazy lows in stocks. But then we V-shape recovery, and oh man, missed the dip unless you happen to be live, either watching my live stream or watching the market yourself for that 15-minute period of time. If you woke up later in the day on Tuesday, you would have missed the dip. Sorry, sucks. But hey, that's why we wake up from market open and stay up for market close, and then just stay up normal hours after that and basically never sleep. Okay, maybe that's not a good idea. But anyway, today was worse. Today was not a V-shaped recovery. Today was literally a slip and slide straight down for virtually all stocks. There was no safety today. We had airlines down, cruise lines down, tech down, recovery stocks were down. You'd think, oh, maybe this is a rotation from tech to recovery. No, everything smashed, shattered today. Disgusting day. Why? What happened? Well, I'm gonna keep this as simple as possible because it gets frustratingly tricky and it doesn't need to be. The market went down and there's a very simple reason why. And the simple reason has to do with bonds, the Treasury bonds. Nobody wanted to buy Treasury bonds today. Now, if you don't know what a Treasury bond is, let's put it this way. Let's say this is a stack of Treasury bonds, and the Treasury Department's like, I got 3 bonds I want to sell here. Who wants to buy my bonds? And if you buy this bond, the bond says, hey, this bond's going to cost you, say, $1,000, and it's going to pay you $20 for every year that you hold it. And you basically take a little coupon off the end and go, I'd like to redeem my $20, and then they pay you $20. And it's a 10-year bond, so you got, 10 little coupons. That's basically how bonds work. And so there's a 10-year, there's a 5-year, there's a 2-year. I mean, there's so many different kinds of treasuries. A 30-year, it doesn't really matter. They were even talking about 100-year Treasury bonds at one point. But anyway, the rates on these bonds are rising. They're rising for a few different reasons, but what's most important is that they are rising. When these Treasury bond yields rise, the market starts looking at that as, okay, that's actually a little bit tempting because the more I get paid owning a risk-free asset, and when I say risk-free, there's an asterisk there because there's really nothing that's risk-free. But a Treasury bond is deemed to be risk-free because it's backed by the full faith and credit of the United States. Anyway, if you can get 1.5% or 2% or 2.5% on a Treasury bond where there is zero risk, why take risk in, let's say, an S&P index fund and make 5% on your money if there's a risk of a correction or a collapse in prices? This is why when you have companies who need cash regularly, like Apple or whatever, they can't take all of their cash and just YOLO it onto a bunch of stocks because they can't be exposed to that market risk. They want to be able to go buy other companies or come up with new products. They need that cash. They park their money in what are called marketable securities. This is why when you ever look at an earnings report, which maybe you don't, but it's there, you usually see the first line is cash and marketable securities. So those would be things like Treasury bonds. Okay, so the Treasury bond yield goes up. And when the yield goes up, it actually becomes less desirable for people to buy stocks. And there's a particular tipping point where that becomes very prominent. There are 2 points, one on the 10-year Treasury bond and one on the 5-year Treasury bond. On the 10-year, that point is 1.5%. So when the yield on the 10-year Treasury is over 1.5%, stocks tend to sell off in reaction to that. When the yield on the 5-year is over 0.75%, stocks tend to sell off in reaction to that. Well, both of these skyrocketed past that. The 10-year Treasury at one point went well over 1.55%. Bloomberg reported it touched 1.6% for a brief moment. The 5-year Treasury shot up the fastest it has ever shot up in over 10 years. In over a decade, the 5-year Treasury shot up faster than it ever has before. This spooked the market, and we literally tested new low, new low, new low, new low throughout the day. We had a bunch of V's in today's chart, except the trajectory of the entire stock market's day was down, down, down into the gutter. But wait a minute. Why are these yields going up? Like, what is causing these yields to go up? So we get it. The yields going up on these treasury bonds are leading people to sell off stocks. Okay, but the question is, why are these yields going up? We get now what happens when the yields go up and how the market looks at these thresholds for warning signs, but why? Why are these yields going up? There has to be a reason. And there is. In fact, there are 4 different reasons. Now I'm going to break down these reasons, but first I have to say cheers with a cup of coffee and thank you to the many of you who have created a second-day record for signups to the Stocks and Psychology of Money program, linked down below. I appreciate all of you so much. If you have not considered checking it out yet, check it out. Use the coupon code linked down below. I keep adding content every week. I'm technically still developing the last 20% of the course, which is the hardest part to develop, but you get all that content for free. You get access to the member live streams right away, the member Discord, great community. Would love to see you there. Link down below. Okay, so there are 4 reasons why treasury yields are skyrocketing. Okay, first, let's go back to this bond. If somebody doesn't buy this bond and the US government's like, hey, we want to auction off these bonds. Who wants to buy these bonds? And the government's like, crickets, like nobody's there. And they go, okay, what if we drop the price of this bond? You know, instead of $1,000, what if we just charge, I'm going to be extreme here, half? Remember you, at $1,000, you were getting $20, right? Well, what if they said, well, what if we drop the price half to $500? Well, all of a sudden, you'll have a bunch of people who buy it because the yield just doubled in that case. Remember, when the bond was worth $1,000 and the bond was paying you $20 coupons, that's 2%. But if the price comes down to $500, now you're paying $500, the coupon still says $20 on it. That means the rate you're getting is 4%. So the yield goes up. So in other words, the yields or the rates on the treasury bonds go up when nobody wants to buy them. So why does nobody want to buy the darn bonds? 4 reasons. Number 1, massive stimulus coming. $1.9 trillion of stimulus is getting closer and closer and closer and closer. Well, guess how the government raises the money to do all the stimulus? They sell treasury bonds. They take out another booklet and they go, this booklet has $1.9 trillion worth of treasury bonds. Hey, who wants to buy another bond? And when they have a whole nother booklet of bonds coming, people today are like, why would I buy the bonds you have right now? You're about to flood the market with a whole set of other bonds. And when you flood the market with a whole set of other bonds, we could just buy those at probably even lower prices because there are going to be so many bonds available. And as the supply of bonds goes up, the price continues to come down. So in some sense, people are anticipating that more bonds are going to hit the market and the price is going to come down even more. And because stimulus is coming, and because of that, the rates go up. The second reason is strong growth is coming to the economy. Now, this is a little bit of an ironic one, but the irony is people are like, man, why would I buy a 10-year treasury bond and get 1.1% interest? Why would I do that? Come on, man. There's so much opportunity in the stock market. Look at earnings. Etsy beats, Airbnb beats, Beyond Meat gets new partnerships. I mean, these are huge, huge, like earnings season is so powerful right now. So they're like, why would I buy bonds? Let's just stay in stocks. And ironically, that actually leads less buyers buying bonds, yields go up, which then hurts stocks. It's a disaster, right? The third problem is people are expecting inflation to come. When you expect inflation to come, guess what happens? You're like, 1.1% treasury yield or even 1.6% treasury on the 10-year. Nah, man. As soon as inflation comes, that's going to be a joke. Because if we're at 1.6% inflation or worse, 2% inflation, I'm upside down on my bond. I'm technically losing money. The real return, basically the return you're getting, the coupon you're getting minus inflation, is negative. Why would I buy that crap? I'll wait for rates to go up and buy myself some juicier bonds. And the fourth thing, literally there are 4 reasons why people are not buying the bonds right now. The fourth thing is like, why would I buy bonds right now? Jerome Powell's gonna end up flipping and he's gonna end up raising rates sooner than expected anyway. Why would I buy your crappy bonds right now? I'll just wait for Jerome Powell to raise rates and then I'll get my 3% yield on a 10-year. Yeah, so literally 4 massive reasons why people are like, why would I buy your bonds now? Come on, man. Again, massive stimulus coming. Strong growth coming. inflation, and an eventual rate hike. All reasons why right now we're not seeing people actually flock to these bonds, and as a result, these yields are going up. And so this then begs the question, why are stocks falling? Again, kind of going back to the stocks question. Well, it could be a multitude of reasons. I mean, we've got the GME short squeeze. To cover short squeezes, you might have to sell some of your longer term holdings like the Apple, the Microsofts, the Etsy's, the EXPIs, right? These more bread and butter stocks, the Redfin. Oh my God, don't talk to me about Redfin today. That was a disaster. Woo-hoo, yeah, bad. Okay, real bad. Redfin, great company, but wow. Anyway, we don't have to talk about that. I got coffee, and that's okay. But anyway, so people sell off these other stocks so they can cover their short squeezes. Okay, that's one reason. But also, when we pass those thresholds that we talked about in the Treasury market, well, then we see stocks sell off because people get nervous. But people aren't necessarily parking that money into Treasuries to bring the yield down on Treasuries. It seems like people are selling stocks, and then they're either YOLOing it on GameStop, or more likely for businesses and corporations, maybe they're increasing their cash right now, thinking, well, let's wait to buy bonds. Let's sell off some of these other stocks we have, whether the hedge funds or whatever. Sell off some of these stocks we have, hold cash, or in some cases, hold Bitcoin, which ironically, Bitcoin was very, very stable today. Around 49,000, I'm actually really impressed. Which remember, if you want to buy Bitcoin, go to metkevin.com/BF. They'll give you $250 totally for free just for opening an account and depositing money with BlockFi. So check that out, metkevin.com/BF. Okay, so it did actually start trending down a little bit later in the day. There was a period where we crossed 50,000, but realistically, sitting between 47,952 or 50,000 rather is about a $2,000 swing. That's about a 4% swing on Bitcoin in the day, and that's a swing in the day, right? That's not bad compared to like the 10% sell-off we saw in a lot of stocks today. So surprisingly, Bitcoin's stable. Bitcoin, the more stable it is, the more people and more corporations might actually end up moving into it. One of the biggest complaints about Bitcoin is its potential volatility. That might be a reason for people not to invest in Bitcoin because it's not predictable. It might not be predictable cash when they need it. Anyway, all of this is happening, by the way, at the same time as valuations are kind of high, right? Margin levels are at record highs. We're at the highest point in margin debt that we have been in 3 years. And we're anticipating this rotation from these tech stocks into maybe non-tech stocks, even though everything got smacked today. So today was a complete disaster. This is a full explanation of all of the different things that are causing this problem today, whether it's stable Bitcoin, the bond issues we talked about, and the 4 reasons people aren't buying bonds, margin levels being high, maybe people are out of money and they can't actually go buy anymore, because if you buy more on margin while the market's collapsing, you're actually burning the candle at both ends of the stick. You're increasing your debt and your portfolio value is going down, and you increase the odds of getting a margin call, right? And this rotation anticipation totally makes sense. It sucks. You know, diamond hand this to the moon, but folks, whoo, I just lost lots of money. Thanks so much for watching. Check out the courses, link down below for private live streams and private chats and lots of education. And folks, we'll see you in the next video. Cheers.